Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really happy to have with me for the first time Michael Pento. Michael is the president and founder of Pento Portfolio Strategies. He is a well-established specialist in the Austrian School of Economics and a regular guest on CNBC, Bloomberg, Fox Business News, and other national media outlets. In fact, in preparation for my discussion with Michael today, I viewed his recent interview with our good friend, Dr. Ron Paul. Michael also produces the weekly podcast, The Midweek Reality Check, and he's also the author of a book, which I haven't read yet, but I'm definitely going to. It's called The Coming Bond Market Collapse, and I hope I get it read before that happens. Let me strongly suggest that you visit Michael's website at pentoport.com to keep up with his work, and because I think it's very, very valuable. He does see the world through the lens of an Austrian economist, and as regular listeners of this show know, I believe that is very, very important, because I think the Austrians come the closest of anyone to describing the economic world the way it really is, as opposed to the rose-colored glass view of our Keynesian economist. I don't want to call them friends because I don't know that they are. But anyway, Michael, you are a friend. Thank you so much for joining me today.
A friend and a brother. Thanks for having me on, Jay.
Absolutely. Well, before we get started, I do want to give you a chance to talk a little bit about your firm and what services you offer and what might be available to people, to take advantage of your insights into the markets.
Well, first of all, I'm a RIA, so I manage money for a living. I have a proprietary model called the Inflation-Deflation Strategic Portfolio. Basically, the premise there is that we have reached a level of debt in this world that requires that it's defaulted upon either through inflation, money printing, or deflation, an explicit restructuring. And that means that we are doomed to either suffer through a period of deflation, which, by the way, I think would be very healthy, and the sooner it happens, the better off we're going to be as Americans. But if we suffer through deflation or an explicit restructuring of the debt, that's a totally different dynamic in which to invest through. Mm-hmm. Alternatively, I think we're going to suffer through massive inflation first before we resign ourselves to taking our real medicine. And that, of course, is a totally different construct than how you invest a portfolio. So that's the basis and the progenitor of the inflation-deflation dynamic portfolio. It's proprietary. I created it. It's working very well for us here at the Pento Portfolio Strategies. Also, we have a podcast. It's a very nominal fee, $49.99 a year. You can go to the website and see it's pentoport.com. You can email me directly, mpento@pentoport.com, and the office number here is 732-772-9500 if you'd like to speak to me about how you can avoid getting your assets crushed for the third time since the year 2000. And I say crushed, I mean probably north of 50%, and that's being conservative.
Yeah, I would guess. I mean, it's certainly a 2008-2009 event. A lot of people saw that happen of that magnitude. So if I read you right and other Austrian economists, probably things are worse now by far than they were at that time in terms of the total debt and so forth. Well, anyway, I want to get into the discussion for today then, which really has to do with this whole issue that you just talked about, but in more detail. Michael Oliver, who for me personally is the most helpful technical analyst that I've ever used, he's also an Austrian, by the way, but he relies on technical analysis, his own proprietary work. He's convinced that the big event for 2018 will be the demise of the so-called safe government bonds, like the German Bund, Japanese government bonds, and the 30-year U.S. T-bond. So I've not, as I say, I haven't had a chance to read your book yet, though as an Austrian I have a pretty good idea of what I will expect to read there. But from what I have read about your book, I'm guessing that you probably, or you might very well agree that 2018 might be a rough year for sovereign debt markets.
I think it's going to be finally the year where reality check hits the markets. So we have constructed a situation where the total debt since the year 2008 has increased by $70 trillion globally. And when I wrote the book in the latter part of 2012 and early 2013 when it was published, I never imagined, Jay, that sovereign governments could issue debt and get paid for doing so. And interest rates were already low, but they weren't negative. At one point, we had $14 trillion worth of negative yielding sovereign debt in the world. And you think about that happening, in history, it's never before occurred, and it probably never will again. Not only that, you have a condition where the Federal Reserve in 2018 will be selling $50 billion worth of bonds per month, and they will sell. People say that the Fed doesn't really sell, they just unwind. Well, the Treasury is going to ask them, you're not buying my bonds anymore, so I have to then sell $50 billion worth of bonds per month to the public instead of paying the Federal Reserve and having that interest credited back to the Treasury. So we have a situation in 2018 where central banks are pulling away their stimuli, and that stimulus was $120 billion worth of money printing every month. It's going from $120 billion to zero by October of 2018. And the only central bank in the bond printing business at that time is going to be the Bank of Japan. So reality is going to hit the bond market. And when you say, for example, you mentioned Germany, the German Bund currently yields 0.4%. Now, how in the world do you have a bond that yields 0.4% when nominal GDP is 4% in the 10-year, by the way, that's the 10-year German Bund. Nominal GDP is north of 4%. The central banks around the world have adopted a 2% inflation target. Mario Draghi, the head of the ECB, is halving his QE come January from 60 to 30 billion and getting out probably between October and December of next year. How the heck can you have a Bund yield, the German Bund 10-year yield of 0.4%? Now, that yield is most likely going to shoot up, and it's not going to be gradually done and seamlessly occurring as the Federal Reserve and the ECB and the BOJ and the PBOC would like you to believe. Interest rates could violently spike in 2018, and if that's the case, that's a very cogent scenario. If that's the case and they spike on the additional $70 trillion, it's now $230 trillion in global debt. When borrowing costs spike across the fixed income spectrum in 2018, we will surely pop the bond bubble by definition, and you will surely pop the global equity bubble. And that's going to bring on, I'm afraid, a global depression, the likes of which we've never seen before. But I will quickly like to be positive and add that is exactly the cathartic rebalancing that absolutely needs to occur.
For sure, but why wouldn't the Fed and other central banks not do what they've always done in these circumstances, and that is just go out and do that much more QE?
Well, I think they will. I think they will, Jay. But central banks do what they always do first, which is invert the yield curve. And if they invert the yield curve, they're already on the way doing it. It was 243 basis points about a year and a half ago. Now it's just 60 basis points, the spread between the 10 and the 2-year note. We have in the Fed's dot plot, we have at least 3 more rate hikes in 2018 scheduled. That most likely is going to bring the Fed funds rate above the 10-year note. And if that's the case, so here's the dynamic. Either you invert the yield curve, you cut off the credit channel, asset prices tumble, and you have a recession, like that is what always occurs. Or alternatively, because of all the things I mentioned, we have growth that's supposedly accelerating, synchronized global growth, inflation is rising towards the Fed's 2% target, the ECB is cutting its QE program in half, the Fed is raising rates 3 times next year, the Fed will be selling $50 billion come October in bonds. It's possible that yields could just absolutely become unglued and spike higher. So that's the entire construct of the artificial edifice built by central banks is that yields are going to be very volatile. They are either going to invert the yield curve or there's going to be a collapse in bond prices sending yields soaring. One of those two things is almost guaranteed to occur, and they both yield a global recession/depression.
You indicated a moment ago that you believe that inflation will precede deflation.
Yes.
So do you see? So right now they're increasing, the rates are increasing, whether that's really the Fed's doing or whether the markets are demanding it. I would like what is your thought on that?
I'll comment on that, Jay. So you said the rates are increasing. The yields are increasing on the short end of the yield curve, not on the long end.
Okay.
The first rate hike occurred from the Federal Reserve, if you remember, in December of 2015. And the yield on the 10-year Treasury was about 2.4% at that time. Mm-hmm. Well, the yield on the 10-year Treasury after 5 rate hikes is, guess what? 2.4%. So the long end of the yield curve says, yeah, great. I'm glad you're finally starting to reverse policy and fighting the inflation you've created in asset prices. But I believe the 10-year note is telling you, longer duration bonds are telling you that a recession/depression is on its way, and the Fed is hiking into that slower growth. And the reason why they're hiking isn't because we have some kind of massive breakout in consumer price inflation, and they're not hiking rates because of some runaway GDP growth, as if there ever could be such a thing as runaway GDP growth. They're hiking rates because they need to get further away from zero, so they have some bullets in the chamber to fire once the next recession commences. So right now we have 125 or 150 basis points that we can take away to combat the next recession and to get asset prices into another bubble. But in 2007, we had 525 basis points. Mm-hmm. And by the way, in 2007, the Fed's balance sheet was $800 billion, not $4.5 trillion.
Yep.
So they have much less capabilities at this point. I mean, they could take back their rate increases. They could go back into QE. But if they do so, I'll just say this to you, Jay. If they were to do that now, let's just say the next recession becomes manifest in the middle of 2018 and the Federal Reserve starts taking back their rate hikes and goes back to QE. I mean, wouldn't the bond market, wouldn't the holders of fiat currency agree that the Federal Reserve and central banks could never normalize interest rates if they can only get to 1.5 or maybe 1.75% of the Fed funds rate? Wouldn't it be commonplace to assent by the market that we will never go back to a normalized construct of interest rates? And that means that people will lose faith in the fiat currency regime, and that would be wonderful for precious metals, not cryptocurrencies, precious metals.
Okay, I want to get into cryptocurrencies before we complete our discussion today.
Oh boy.
But in any event, so let me just understand you. So what we're facing now probably in 2018, if Michael Oliver is right, if you're right, and we start to see interest rates spiking up, I mean, eventually, and it makes sense to me that the long end of the yield curve isn't responding because the market is looking out there and saying things aren't that good. Rates aren't rising because the economy is wonderful. Rates are rising because the Fed is pulling back a little bit of money out of the system. So it seems like what we could see then is a replay of 2008, 2009 this year that would send prices of everything plummeting, just as it did in 2008, 2009, because when the margin clerk calls, you have to sell what you're able to sell. And I think that's one of the reasons that gold took such a hit initially, but then of course it was very strong after the initial decline. But do you see then possibilities of a deflation this year, a deflation in the sense that prices across the board, all manner of prices, equities, commodities, housing, everything collapses with this bond market spike?
Well, first of all, gold got hurt in 2008. Yes, it was part of a margin call, but it was also part of a U.S. dollar repatriation effect. So if you remember back in 2006, we had the BRIC trades, Brazil, Russia, India, China, where people were borrowing in dollars and investing in higher yielding currencies.
Yes.
Well, when it became obvious that we were having a global recession that was becoming manifest, what did you have to do? You had to close out that carry trade, which required you to sell Brazilian currencies and the Russian currency and the Indian currency and repatriate those currencies into dollars. That's the dollar rising, which was a big factor in causing gold to fall, at least initially in between August and August 2008 and March 2009. And that is not the case today. If anything, you have the reverse of that, where people are piling into dollars to get the higher yield here. rather than owning, yield sovereign bonds in other countries. So you don't have that effect. But you asked me if you could have a deflationary effect. Well, the total market cap, this is one of my favorite indicators. It's also the favorite indicator of Warren Buffett. The total market cap of equities as a percentage of the economy now stands at an eye-popping 143%.
Wow.
That has never before happened outside of a very short few weeks in, guess what, late 1999 and early 2000.
Yeah.
So, by the way, the normal ratio is 50%.
Yeah.
And if you look at global asset values as a percent of worldwide GDP, that figure is now 3.5 times.
Wow.
So global asset values, which is most primarily stocks and bonds, 3.5 times.
Incredible.
Global income. In 1980, that ratio was 1.1, 110% of the world economy. So that's how, you ask me, you say, well, are we going to have a deflation in asset prices? We're going to have an absolute crash. And if you add to that, by definition, the crash in bond prices, which is going to be caused by inflation or through central bank actions, they do that themselves as they raise interest rates. And you add the record value in real estate prices, you have a bubble in everything right now.
Yes.
Concurrently. And they will crash concomitant fashion in 2018 is my belief, towards October, when we get to the point where central banks go from manipulating yield curves, manipulating bond prices across the globe in massive fashion. They printed $15 trillion since the Great Recession. They're going from, like as I said before, $120 billion per month to zero. When that occurs, you're going to have real markets price sovereign debt, and real markets will begin to price the asset prices of stocks and real estate, and that's when the crash really comes.
The Jim Rickards, who we've had on the show, has talked about, the next time there's nobody left, basically the central banks will be in such bad shape that they won't be able to bail anyone out, that the only thing standing will be the IMF, and the IMF then will look to pull together, into sort of a one world, I guess, SDR currency or something like that. Yes. Yeah. Do you see that as a possibility?
I see it as a possibility. I don't put a lot of credence to that. I mean, if you don't trust central banks anymore, you're going to trust Madame Lagarde.
Yeah.
I mean, you're going to see an eschewment of global fiat currencies. And I think that's going to drive people back into gold and demand that their money is backed by specie once again. And again, I don't mean Bitcoin. I don't mean Ethereum or Litecoin or any of these other make pretend forms of money. I mean gold. And the reason why people love gold so much is because it's virtually indestructible and extremely rare. There are not many elements that you could say that about, and have shown to maintain their purchasing power for 5,000 years. And now with the modern invention of the internet and private blockchains, you can move gold around the world virtually instantly at very low costs. In fact, almost zero costs.
Yes.
So the fact that gold doesn't make a very good currency, you can't lug around bars of gold. That used to be true. Gold is perfect money, but not a perfect currency. Well, now it's perfect money and a perfect currency thanks to companies such as Gold Money, which is a company I own here in the portfolio.
Yes, okay. I'm glad to hear that because I own some shares of Gold Money as well. I've known the company for, well, of course, Gold Money, the old Gold Money, James Turk's company, which then was merged with BitGold. The two of them now are combined into Gold Money. And it seems brilliant to me, Michael, because it is marrying the old, one of the oldest, if not the oldest form of money with the newest form of money, if you consider blockchain money. It certainly is a transportation device that can move money around without so much friction as you have in the banking system. Do you think that's got the bankers a little bit worried, this technology, that they may lose some business, or do you think they'll try to grab a hold of the technology and use it themselves? Which leads me to still another thought, this whole idea of cashless society. And chips emplaced in our bodies that will allow us. All those topics are things that are swimming around in my head and worrying me somewhat.
I think I read about something like that in the Bible. So, but anyway, so I have my own. I'm not one, Jay, to embrace conspiracy theories with alacrity, but I can tell you this: that the creators of Bitcoin, this person, Satoshi Nakamoto, or whoever this person who no one can find and they're not really sure even exists. I think the creators of Bitcoin and cryptocurrencies are governments and central banks. That's what I think created Bitcoin. And I think they did so for a reason, is they want to get the citizens of this world used to using digital currency. I think they're going to ban physical cash. And I think the reason why they're going to do this is a nefarious reason. I think because they understand that central bankers have very limited power to create inflation after this next recession/depression ensues. I think they're going to go to something called negative interest rates. And negative interest rates are a way to rob your purchasing power without you having any possibility of escaping the loss of your purchasing power. And that can only be done once you abolish cash. So, and they can't really abolish cash unless the public gets used to owning these cryptocurrencies and using them for commerce to buy goods and service with. And if that's the case, after the next recession comes and it becomes a depression and asset prices are tumbling and they're running out of ways to engender asset bubbles, bring them back up the way they did in 2009, the best way they can do that is a combination of negative interest rates, universal basic income, and helicopter money. So if you use those three things, then they will be able to create all the inflation they want to, and there's nothing you can do about it except own gold.
All right. Help me understand how that will help. Then we can have gold in an account like gold money. And, I'm doing that now to a certain extent. I take fiat money and I buy a little bit of gold and I put it at gold money, which I can, by the way, if I choose to, use through my gold money credit card. It's a debit card, I should say, prepaid debit card.
You can monetize your gold instantly if you so desire.
Right.
And so it allows you to... Go ahead. Yeah,
so we know that the dollar and all fiat currencies are losing purchasing power over time. I mean, there's no disputing that fact. And it's losing a lot of purchasing power over time. So over time, we're much better off to exchange our fiat for gold. I can put it at gold money. I can use that. I can turn it into currency whenever I want to. Because I still need to use. I can't take my gold. I can't pay in gold when I go to buy pay for a restaurant or something. So.
Not yet, Jay, but that's not the ultimate goal is. So they're trying to get you away, and they've developed a way for you to escape the entire fiat currency regime.
Right.
So you take your fiat currency, exchange it for gold. Now you can move gold around the world seamlessly, instantly. You can pay anybody for a good or service that you want to in gold.
Yes.
And then exchange for that good or service. Also, what they want to do, and they are well on the way to consummating this desire, is have you directly exchange your gold for a good or service with businesses. So there are businesses already. In fact, I know you could go on a yacht tour of the Mediterranean using gold money. They accept gold as a payment, and as more and more companies accept that, it's almost like they're trying to do with cryptocurrencies. They're allowing you to price things in gold. You can't really price things in cryptocurrencies right now because it's just too volatile. But gold is much more stable in value, so you can price it in gold. And right now, as I'm trying to make the distinction that you can exchange your cryptocurrencies for a good or service, but it's not those goods or services aren't priced in Bitcoin or Ethereum or Litecoin.
Right.
You can, but gold money and merchants that accept gold money allow you to purchase goods and services with gold in terms of ounces or grams of gold.
Sure. Yeah, and it's certainly those that are in the gold money system now can transact business that way right now, gold to gold, essentially, can't they?
Yeah, absolutely. So you can. It's your choice now.
Right.
Thanks to gold money, you can now completely escape the fiat currency regime. You don't just have to buy gold and store it and just look at it every once in a while and, continue appreciating the fact that it's going up in value, but you really can't monetize it very easily without, taking your brick or your coins or your collection and liquidating it at unfavorable prices. You could have your account stored in gold in vaults in Toronto and Zurich and in New York, all over the world. And when you want to use your gold to spend, you can monetize it instantly using a credit card, or you could just move it from another person or business that's on the network.
But you believe eventually that we will be using gold itself and not needing to go into a current fiat currency to buy things. I mean, we can now, as you say, if you're in the system. And I guess what gold money is very, is setting out to do is to get more and more people into that system outside of the fiat system, right?
Absolutely. And there'll be a hue and a cry for this to occur after the next recession/depression commences. Because then people understand that there is no, once the asset prices collapse and they realize they now have no escaping the banking system because they're going to impose negative interest rates on your deposits. And once they realize there's universal basic income and they'll circumvent the banking system, the primary dealers, by directly monetizing treasury debt. And they'll also have things called helicopter money where they directly send money around the banking system directly to U.S. citizens and citizens around the world, central banks directly monetizing debt. These things are going to engender incredible inflation.
Incredible.
And will necessitate you getting out of the fiat currency regime, and you'll be clamoring to buy gold and having a method of conducting commerce with it, utilizing companies such as gold money.
I have no doubt about that, but I also believe that there will be some kickback from the governments. There will be some response from governments as well. So I guess we'll have to see how that plays out. But certainly people that are wise enough, people that listen to what you're telling them, what I'm telling them, Ron Paul and other Austrians are telling them, take the fiat currency while it still has some purchasing power left and use it to buy gold now, because we know gold and silver too will retain value for sure longer term. Michael, just we have to wrap it up now, but just so what are you suggesting to your listeners, to people that pay attention to you? Buy gold. I know that's the first thing you'll probably say. Physical gold, ideally, more than paper gold, I suppose, right?
Of course. So taking physical possession of your gold is of paramount importance. But people who agree, okay, I'll give you an example, Jay. European junk bonds yield less than U.S. 10-year notes at this time. This is one of the examples of how distorted central bankers have pushed the interest rate spectrum. So when this collapses, it's going to end very badly. But it's how it collapses and what to buy and at what time. So first you get the deflation. That's why right now I'm about 10% of the portfolio, the inflation-deflation portfolio, is in gold. I don't just sit here and say short the stock market and buy gold and hold lots of cash. I mean, that's a doomsday scenario that doesn't really work very well in the past few years. So that's why I created this model. What if you had a model that looked at ISM surveys, that looked at yield spreads, that looked at the junk spreads, that looked at the CRB index? I have 10 components to my model. It lets me know where we are on that inflation-deflation spectrum. So I know, well, let's buy dividend stocks now, have some gold as a hedge, own aerospace and defense stocks right now because of that threat we have with North Korea. And then after the recession commences, and we get UBI, Universal Basic Income, and helicopter money, and ZERP and NERP, negative interest rate policies, then you want to overweight gold. So if you can slide along that scale between inflation and deflation, you'll do much better in your portfolio if you can get the timing right, and I'm pretty confident I can do that.
Fascinating, Michael. Really, really fascinating. I want to thank you so much for spending the time with us today and introducing your services and your thought process to our listeners. I really think people should definitely visit your website, learn to know more about what you do, pentoport.com. And I hope we can talk to you again sometime as we slide along this this 2018, and it should be a very interesting, perhaps very challenging year, but if you're ready, you can turn negatives into positives. I think that's what you seek to do with your work. So thank you so much, Michael, for being with us, and we'll look to do it again sometime in the future if you're willing and able.
Thanks so much for having me on, Jay.